The other day, my coworker was telling me about his experience visiting a co-working space. He said each day he went, there was a small group of day traders who spent the full workday buying and selling stocks. And they were so dedicated that they actually put in longer hours than he did with his digital marketing job. Now, I have no idea how profitable these traders were, but in theory, these guys were able to quit their normal jobs and trade stocks full time. And as someone who enjoys investing and researching investment strategies, I got a little envious at the sound of that. But then something clicked in my mind that completely changed my perspective on investing and made me realize that I had a crucial flaw in my own investing approach. And this all comes down to the idea of active versus passive investing. So in this video, we're going to take a closer look at the temptations of active investing. I'm sure most investors dabble in active investing at some point in their lives, probably with one of two goals in mind: doing it for income or simply trying to beat the market. I mean, I've personally tried both of these things. However, I think both of these goals are illusions of active investing that don't give us a full picture of the sacrifices involved. In thinking about these day traders at the co-working space, I realized there are some hidden costs within active investing beyond the risk that you might fail to beat the market. I'll explain how these costs could be far greater than any potential profits from active trading, which is what led me to completely re-examine my own investing strategy. To wrap up, I'll run through how this has changed my approach to investing. I've adjusted my holdings, my main investing platforms, and really my overall mindset about building wealth. This has been a powerful lesson for me that I hope you can find some value in. So with all that said, let's get started. I should probably start off with defining active investing, or at least my definition of it. I view active investing as anything outside of a buy and hold strategy. Typically, active investing will involve trading, especially of individual stocks, using option strategies, and some degree of research for each investing decision. I would characterize this strategy as trying to create higher returns within shorter time frames, which could range anywhere from the occasional stock picking to regular day trading. On the other hand, passive investing would be simply putting money into the same investments month after month. The key here is that you're not trying to time the market, you're not trying to trade around market movements, and you don't get distracted by any short or medium-term positions. This is more of a buy and hold and check back in 10 or 20 years kind of strategy. While passive investing is simple, many investors, including myself, might choose to go with active investing in an attempt to beat the market. Every year, there are dozens of strategies, stocks, and funds that outperform the S&P 500, which is the gold standard for capturing the returns of the market. So it's easy to believe that individuals could identify at least one opportunity to outperform the market and secure larger returns than they could with passive investing. I won't get too into the weeds on this because it's well documented how difficult it is to consistently beat the market. And I'm not arguing that it can't be done, because it certainly has. But instead, I want to focus on this dream scenario of beating the market and the sacrifices it takes to get there. If the market historically returns 10% per year, I think it's pretty fair to say that almost anyone could get lucky and beat that in a given year. However, if you want to beat the market consistently, you'll need to develop a strategy. This might be something like value investing or growth investing, or identifying single stocks that will outperform in the coming years. In any case, this will require hours of research, and likely hours more to manage the portfolio. The numbers are against you, but with enough work, maybe investors could capture 15% returns on an annualized basis. For more aggressive returns, investors are going to need to be incredibly lucky, incredibly risky, or a combination of the two. Achieving greater than 30% returns will likely involve some sort of leverage, whether that's investing on margin or using option strategies. Or maybe it involves actively day trading and trying to secure profits every single day. Again, not to say that it can't be done, but it gets increasingly unlikely that this will work continuously from year to year. And you'd probably have to dedicate some serious time and research to pull it off. Finally, some investors might say that these higher annual returns aren't enough, and they want to day trade and make a full living by trading the stock market. And this is where our day traders come back into the conversation. They made the decision that they would rather spend their workday reading charts and placing orders than working a different job. I told you that I was initially jealous that they were able to make this happen because it sounds like a dream come true to trade stocks for a living. But that was until I realized that they really just traded one job for another. Now, I don't know what they were doing before or how much money they were making, but it seemed to me that they don't have a vastly different lifestyle than anyone else working a standard 9 to 5. They're working from market open to market close, and probably with a lot of stress if day trading is their only source of income. To me, and maybe to you as well, active investing seemed like a life of financial freedom and early retirement. But these day traders made me realize that that was just an illusion. They still had to work every day in order to create returns and make a living. And this made me take a second look at the other active investing strategies, which are really just a simpler form of a day trader's goal of getting maximum returns. For example, I would place myself somewhere between the moderate and aggressive strategies, which involved a lot of research into stocks and funds, and also a lot of time watching the market. I realized that while I didn't try to take on day trading as a full-time gig, my active investing essentially became a side hustle. I was spending hours researching and engaging with the markets in an effort to beat the returns that I could get by simply passive investing. Then I had to reconsider my own approach to investing. The question I had to answer was, is the time I'm spending researching and being active in the markets actually delivering greater returns? In other words, am I being sufficiently compensated for my active investing strategy based on the time I'm putting into it? My answer was a definite no, and here's why. For starters, the S&P 500 has been on an absolute tear for the last year, and I've only made a fraction of the returns with my strategies during the same time. But performance aside, the biggest issue I found in my own active investing strategy is the time I was trading off in order to chase those larger returns. Again, I've spent at least a few hours a week researching investing strategies and stocks over the last several months, as well as time actively checking and managing my portfolios. I would probably tell you that this time was well spent if I was able to beat the market, but even if I did beat the market, that might not be the case. For example, the S&P 500 has a trailing one-year return of about 30% at the time of writing. Let's say my goal was to beat that and earn a 40% return over the same time period. To do this, we'll say that I spent 3 hours a week researching and managing my portfolio, which is probably a low estimate for most active investing strategies. Over 52 weeks, that's 156 hours of work to gain a small increase in returns over the market, compared to the strategy that required absolutely no research or thought whatsoever. Now, if I had $1 million portfolio, it's probably worth spending that time to create another $100,000 in wealth. That comes out to about $640 per hour spent actively investing. But the reality is, my entire net worth across my investment accounts is only about $50,000. I'm still proud of what I've built, but those extra returns aren't worth nearly as much as the time I'm putting in. In comparison, an extra 10% returns above the market would only earn me an extra $5,000 on my current wealth, which comes out to about $32 per hour spent actively investing. And these are still decent hourly earnings, but you have to consider the other facets of active investing on top of that. As we know, these returns aren't guaranteed, and you might fail like I did. Then, you're in a situation where you've put in this time, but you don't actually have the returns to show for it. Most importantly, you have to weigh the opportunity cost of focusing that time on investing versus focusing it elsewhere. And this is really where active investing can hurt you. In a perfect scenario where I beat the market by 10% in this example, I'd have created $32 per hour of work, but those are completely active earnings. On the other hand, I could have spent 3 hours per week investing time into myself or other projects, which might have eventually paid off even greater than active investing. For example, I could have spent 3 hours per week learning a new skill that would make me more valuable at work, thereby increasing my salary level for life. Or I could have spent this time building an online business, which would eventually grow into a passive income source that pays me for years to come. The point is, there are so many other ways I could be spending my time that will have a higher ROI than focusing my time and energy on trying to beat the market. The cost of active investing is that I miss out on those opportunities, and this cost becomes even more severe when active investing doesn't beat the market, which is the most common outcome. Ultimately, I've grown to realize that it's kind of silly to pass up the returns of the market. With passive investing, I can reliably grow my wealth while focusing all my time and energy on more lucrative opportunities. No matter how much research and effort I put into picking stocks and maximizing returns, I think I'll be able to make more money in the long run by minimizing my time spent actively investing. Plus, then I can enjoy the growth that the stock market provides without feeling like I've turned investing into another job that I have to do every day. In order to make this shift, I'm changing a few key things in my investing strategy. The goal here is to make investing as frictionless as possible. I don't want to have to check the markets every day or spend more than a few minutes a month managing my portfolio. For me, this starts with limiting my use of the Robinhood app. I've primarily used Robinhood for free options trading and low-cost margin investing, both of which make me feel like I've got to watch my portfolio very closely. This turns into me checking my portfolio almost daily and trying to time the market every time I see significant price movements. All of this is just dangerous for my mental health, my productivity, and my returns, and I'm happy to say that I'm finally focusing on a brokerage that aligns with my investing goals. I've been using M1 Finance for a while for my Roth IRA, but moving forward, I will also be using it for my primary taxable investing account. I'm confident with this decision because M1 Finance is built to support the practice of passive long-term investing. After setting a desired allocation to each holding, each dollar invested or reinvested into the portfolio is spread evenly across all holdings. If something is underweight due to price movements, more dollars will go to that holding to keep the portfolio properly balanced. This means the portfolio will gradually allocate more dollars to undervalued holdings over time, which is a strategy I would use with active investing anyway. This means all I need to do is select my holdings and deposit money into the account every month, and the rest is taken care of. This will reduce my time spent investing to practically no time at all. And I'm also tweaking my holdings with my move to M1 Finance. In my video about quitting dividend investing, I discussed how I was going to focus on long-term call options, thematic investing with individual stocks, and regretfully, SPACs. The problem is most of these holdings were shorter term investments, and therefore required me to monitor my portfolio to see when it was time for me to sell and move on to another position, all requiring more time and more activity. On M1 Finance, I will be focusing the majority of my portfolio on index funds and ETFs with a small portion of individual stocks. I still plan to follow a growth investing strategy with my largest allocation to ARK Invest funds. I'm also still keeping some of my high conviction individual stocks, but at lower weightings to reduce my portfolio risk. Additionally, I'm adding total stock market index funds to my portfolio, which is something I previously told myself was too safe for my aggressive growth strategy. I'm still comfortable with some risk, but I can sleep much easier knowing that at least a fraction of my portfolio is practically guaranteed to grow over the long term. A common thread between all of these holdings is that I'm comfortable holding them for at least the next few years, which means I won't ever have to adjust my portfolio unless there are major changes, resulting in a truly passive investing experience. The one thing I am missing on M1 Finance is options trading, so I'll continue using my Robinhood account for the small and responsible use of options. In order to minimize risk and make it as passive as possible, I'm going to stick exclusively to long-term call options, aka LEAPs, and only on index funds and ETFs. Overall, this strategy should produce more predictable returns and require minimal effort, giving me more freedom to build my wealth elsewhere. Of course, I'm also in a unique position because I can make money by researching investing strategies and sharing them with you all on this YouTube channel. In fact, part of my value proposition is that I break down different strategies and products to help other people determine if they fit within their own portfolios. It does feel a little disingenuous to now advocate for passive investing when some of my previous content could be taken as suggesting the complete opposite. And to be honest, I don't really know what this means for my channel yet. I want to make content that aligns with my own strategies and delivers value by sharing my personal experience. But this can be tough to do when the content that is most successful for me is about strategies that I don't even use myself. All I can promise is that I will continue to be as transparent as possible, and I hope you guys will continue to follow along as I navigate these topics. With that, please leave a comment if you have any feedback for me, and don't forget to check the description below to get $50 at M1 Finance, as well as some other free offers. Thanks for watching, and I'll see you next week.